Look, I think we're in an environment where inflation is surprising to the upside. I mean, whether or not tomorrow's print surprises to the upside, I think we just need to brace ourselves for a very different regime going forward. I mean, if you think about it, we are in an environment where Fed liquidity and government liquidity is on pause, if not tightening. We're seeing central banks across the globe basically reverse this liquidity that they've given us for the last 10 years. And I think that leadership is going to look very different from what we've seen over the last decade or so. So I think what's really interesting right now is we're seeing the same types of kind of entrenched growth biases amongst investors that we saw coming out of the tech bubble. It's really hard for investors to give up on the sector that made them lots of money in the last market cycle. So I think the pain trade is still down in tech and up in value, energy, financials, sectors nobody really owns at this point. I think, Andrew, I think what's also interesting is that in 2008, we saw the same thing with financials. Investors were overweight financials for, 3 or 4 years until, 2011, 2012, 2013, when they gave up on financials. So I think it's one of those environments where we're all just kind of waiting for tech to recover from the ashes, and it may take a lot longer.
Any chance it happens sooner, meaning that things are not as bad as we think? Or you with Cardi B over the weekend tweeted out, when you all think they're going to announce that we're going into a recession? Are you with Cardi B and Jamie Dimon or others?
Look, I think we could very well head into a recession in the next 18 months, and our economists assign a higher probability. But I don't know if you want to be in tech stocks in the next recession. I think the next recession is going to be driven by hyperinflation or stagflation. Rates are a lot higher today than they were in the last few years. So I think we're going to be in an environment where you don't necessarily want to buy tech and long-duration companies in the next recession. They might not be as defensive as we think. We're seeing that cyclicality show up for a lot of these so-called secular growth stocks. We're coming out of COVID. We've seen demand pull forward for a couple of years. So I think that tech might not act the way tech did in the last recession going forward. I think financials might actually act a lot better in the next recession. This is a sector that's well capitalized. Balance sheets are pristine. These haven't really been the companies that have been lending, so they're less economically sensitive than other areas of the market. And, I think it's going to be a different type of recession than what we saw in 08, 09.
So you think financials are the safe place, or do you think cash is a safe place? We've talked to Ray Dalio, who thinks that cash is trash, but there's others who say hold on to your cash because there's going to be an opportunity and you may actually need it or want it.
I think that's absolutely right. I mean, cash is king in this type of market. The Fed is hiking, and we're moving from 0 to 3 in returns on cash. I mean, that's a monstrous move. Meanwhile, financials, energy, the sectors that are producing cash flow are the most, reviled sectors in the S&P 500. So we're at a really interesting point in terms of ownership being convergent in hypergrowth, long duration, but the real winners might be in these free cash flow yielders that haven't really caught a bid for many, many years.
Shepard Smith here. Thanks for watching CNBC on YouTube.